Hello, welcome everyone to the second session of this interesting conference on corporate purpose. We will have a session now on the company valuation and the effects of ESG factors. As you know, those factors are gaining weight in both the private and social performance metric for firms as well as for managers. Investors are paying attention to those factors, but still there is no consensus on their impact. As an example, on the positive side, the Church of England Pension Fund states clearly that it's a goal to deliver on its commitment to be aligned with the Paris Agreement on climate change. But this is just one example. There are other examples which do not follow this approach. Rising temperatures and climate change are at the forefront of the policy debate, as you know. This has been helped, in fact, by some recent events, such as more acute weather variability, the fires in Australia and California, which have definitely concentrated minds on this issue. The question arises whether carbon emissions represent a material risk for investors and firms, and whether this risk is reflected in stock returns. This risk may be technology risk, maybe regulatory risk, maybe political risk. Obviously, today we know that if a car company produces polluting diesel cars, it's calling for trouble, okay? But some time ago, this was not clear. So some questions that I think that will be addressed in this session will be whether carbon emissions are a systematic risk factor affecting asset prices, whether if the market underprices carbon risk, whether it could be that socially responsible investors are doing well by doing good, and whether, for example, investors can generate alpha returns by shedding high emitters or not. Today, to talk about those issues and more, obviously, we have first Patrick Bolton, who's a professor at Columbia Business School. He has a distinguished career in both Europe and the US, has been president of the American Finance Association, among many other honors. He's a world-leading expert in corporate finance and corporate governance. He developed contract theory. He's an expert on allocation of control rights between contracting parties and the firm, in particular when those contracts are incomplete. Relevant for the firm choice, the relevance for the firm choice of these issues and for the optimal debt structure, for the optimal ownership structure, for vertical integration, for a constitution design of the very firm. In fact, that's what we are discussing here today. And more recently, Patrick has turned attention to these environmental and sustainability factors, like the impact of climate change in investors and in markets. As a discussion, we are happy to have Sophie who will comment for about 10 minutes. Patrick will have for about 25 minutes. Sophie is an international corporate governance expert with a lot of experience in shareholder activism and investor campaigns in Europe, the US, and Canada. He's president of LeaderXXchange, co-founder of the International Corporate Governance Network, and she serves on several boards. I think so this will make for a very interesting discussion. So I would not like to take more time from the speakers. Patrick, the virtual floor is yours.
Thank you, Xavier. Thank you for those kind words and for this introduction. Before I start with my presentation, I would like to give a little bit of context and also react to the wonderful first session we've just had with Professor Colin Mayer and Luigi Zingales. So, you know, the theme of the purpose of a corporation, you know, one way of thinking about it, very much how the discussion went in the first panel, is it's a call for ethical behavior. the discussion illustrated that this is a complicated question. Ethical behavior is not simple behavior. It's not as simple as maximizing shareholder value. And I think in corporate governance over the past quarter century or longer, we've been deluded by the attraction of this simple metric, shareholder value. And when we're bringing ethics back into the picture, we're looking at a more complex world. I love to read columns in Sunday newspapers about what's ethical and what's not ethical. You know, every newspaper has that. Those are fascinating reads. It just shows that it's these are complex issues. But we shouldn't lose sight from the fact that there's a reason why we need to call for more responsible, for more ethical behavior, and we shouldn't be discouraged by the complexity when you look at individual issues. And the reason, which brings me now to my talk, I think the overwhelming reason why we have to bring ethics back into the picture is climate change. This has been the fundamental change in the world, and it's the biggest challenge that awaits us in the 21st century. If we were to continue pursuing the shareholder value paradigm, we would be on a road to disaster. Corporations have to change their objective. They have to look more broadly at what they're doing, and they have to take into account the real risk to the planet that is climate change poses. So that's a bit of a long preamble. So despite what I just said, it's not like there is a very wide consensus yet when it comes to climate change. Basically, you know, on the positive side, the biggest change that has happened is the Paris Climate Agreement of around the COP21 on December 2015, which has brought people back to the table and launched the process of national and regional and other commitments. And among the players that have been brought back into the picture, or brought into the picture for the first time, is the business world and the financial investment world. That's really been one of the key novelties of what happened around Paris. And it has led to a rising engagement by the finance industry to tackle climate change, in particular. The biggest asset manager in the world, BlackRock, has taken a very clear view on that front. But nevertheless, that's the positive view. The negative, or if you want, the skeptical view, is still very much something that I see around me here in the US, is that, you know, it's nicely summarized in a quote in a very nice article in the Harvard Business Review by Eccles and Klimenko that came out last year. And they basically state that, let me quote this for you, the impression among US business leaders is that ESG just hasn't gone mainstream in the investment community. And more recently, the CEO of Exxon said individual companies setting targets and then selling assets to another company so that their portfolio has a different carbon intensity has not solved the problem for the world. That was in March of this year. He probably regrets making that statement today. Now, what are we doing in our paper? So the topic of our panel is valuation of ESG. Is there value to pursuing ESG goals? And the answer to this question based on our research that I'm presenting here, there's a joint work with Marcin Kakpersik at Imperial College, is that the short answer to that question is when it comes to one particular aspect of ESG, namely the environment and climate change and concerns about carbon emissions, there is value, definitely value. Coming back to what Xavier Vives said in the introduction, there's definitely material risk currently reflected in stock prices. Okay, and so that's the question we are addressing, is carbon risk price? Our answer will be yes. And that's, if you want, already a very striking conclusion. Another question we're asking is, are stock markets pricing carbon risk efficiently? What do we mean by that? Well, is there an arbitrage opportunity by shorting high emitting companies and going long low emitting companies? And the short answer to that question will be no, based on our analysis. And so what's new here in what we're doing is that we use firm level information on carbon emissions. We also look at the economic mechanisms behind the pricing of stocks or behind the returns. So in very simple terms, our main conceptual framing is that the carbon emissions are a transition risk for corporations because if we want to be in line with the goals set by the Paris Agreement, and we probably have to even go further than that, this requires substantial reductions in carbon emissions for all companies that emit carbon. And to give you a sense of how big, the size of the reduction we're talking about, well, this year we've had reductions in the rate of growth of carbon emissions. We've had negative growth in, substantially negative growth in carbon emissions around the world. Why? Well, because of COVID. Okay, that's the good news of COVID. The bad news, however, when it comes to carbon emissions is that we will have to continue on the same rate of decline in growth rates of carbon emissions around the world as we had this year. We have to keep on doing this, and you can immediately see how challenging that will be. So the pricing of the risk is tied to transition risk, lower carbon emissions in the long run. And then it's also tied to awareness of investors. How aware are investors of this problem? Okay, that was my motivating, going back to my motivating slide in the beginning. And of course, another important aspect of this risk, transition risk, is technological change. We've had dramatic changes in renewable energy, efficiency in the costs, and that's going to continue. And we have a very large uncertainty as to the feasibility of carbon capture technology. So that's the simple framing. There's a dynamic angle to it, but in the interest of time, let me not go into this. So this is something that I imagine is familiar to our audience here today, but let me nevertheless still remind you of what we're talking about here. So what do we mean by carbon emissions? A classification of carbon emissions, and by the way, greenhouse gas emissions more generally. We'll look also at greenhouse gas emissions more generally. Classification is into direct and indirect emissions. And direct emissions are categorized as Scope 1 and Scope 2 emissions. Let me not go into the fine details here. What's the difference? And then indirect emissions are Scope 3 emissions. And those indirect emissions are emissions to produce inputs that go into the production of what the company produces or the services that the company provides. And it's also the use of product downstream that the company sells. So for example, in the automobile industry, selling a car creates a lot of indirect emissions through the use of the car. So that's what we're looking at. We're looking at scope 1, scope 2, and scope 3 emissions, and at the firm level. And we're looking at the current levels of emissions. We're looking at changes in emissions year to year. That picks up a more short-term risk as opposed to a long-term risk with a level of emissions. And then we're also looking at a favored variable in the industry, which is emission intensity. Emission intensity is basically a normalization where you divide tons of CO2 on the numerator by dollar sales revenue number. Okay, and this table here below shows you that these measures are not well correlated with each other. And in particular, what I want to highlight is how for scope 1, for example, scope 1 intensity has a correlation of 0.49 with scope 1 level of emissions. So why is that? Well, because when you normalize, you're mixing in very different kinds of companies. Some companies have high sales and high emissions. Some companies have low sales and low emissions. And so you're mixing these companies together by looking at intensity. That creates a very noisy measure. So what do we find? I want to give you a summary of the results because I know I have a limited time and I'm maybe already behind in my presentation. I hope I be given a 5-minute warning at the end so that I know when to accelerate. So as I said, the headline result is that carbon emissions do affect stock returns. And we find that's true for the stock returns of US listed companies. That's our first study. And then we have a later study which looks more broadly at the stock returns around the world, different countries, 77 different countries. We find similar evidence in most other 77 countries that stock returns are affected by carbon emissions. Okay, so that's a really significant finding, especially since this is the case for all 3 categories of emissions that I've highlighted. There's a positive and statistically significant effect of levels and changes in emissions on stock returns, both for scope 1, well, for all 3, scope 1, 2, and 3. It's an economically significant effect, and it's a robust effect. Not at all obvious, but we would have found this, and I can't underscore how significant enough how significant this finding is. And then we dig into the causes of the link between carbon emissions and returns, and there could be many reasons. For example, you might worry that carbon emissions are just picking up some other risk factor, and so it's just this is just a mismeasurement issue. Now, to address that, we look at a host of firm-level return predictors. They're all the ones that the asset pricing literature looked at, like the size of the firm, book-to-market ratio, and so on. And we find that it cannot be explained. This carbon premium cannot be explained by these other firm-level predictors. The premium cannot be explained by profitability or earnings surprises. So their returns are not high for high-emitting companies because they are more profitable. That's not what we find. And then the time series premium cannot be explained by standard risk factors. Now, somewhat surprisingly, and this ties into the debate we've had in the first panel, the issue of divestment versus engagement, and somewhat surprisingly, we find that the premium is not explained by divestment. The premium is explained by investor attention, greater investor attention. I have some striking results to show you at the end on that. And overall, our take is the best explanation you can find for these results is that they are reflecting investor perceptions that there are higher risks associated with companies that have higher emissions. Okay, that's really overall pretty good news, because it tells you concretely that climate change, this one of the most important aspects, if not the most important aspect of why the environment matters, is become a material risk for investors. So how do we do all this? I will go through this fairly sketchily as I have a limited time. Well, we're combining two fantastic data sets. One is FactSet, which everybody now uses in finance, which gives us the returns information and company characteristics and so on. And we're matching that data set with the data set provided by TrueCost, one of the main providers of carbon emission data at the corporate level. And I should say that TrueCost builds on the work done by CDP. They were really the pioneers here. There are some competing providers out there like MSCI, Sustainalytics, Thomson Reuters, Bloomberg, and IESE, and so on. But they're all following the same protocols. That's the good news. So this data, at least for direct emissions, is pretty high quality data. And so we have almost the entire universe of companies with carbon emission data from TrueCost for the US in our sample. There are basically 60 companies that are excluded. Let me not go into the details of that. So what do we find from this analysis? Well, first important point, this is something that not necessarily well understood by many of you, and that is that when you look at emissions, how much do they vary across firms? How much do they vary across industries? Well, we understand there's a lot of variation across industries. The energy industry has high emissions, utilities and so on. Other sectors maybe have less. So that's what the top table shows you, that there's pretty high variation across industries for all three measures of changes in emissions. But what's striking is the bottom table, which shows you that there's also substantial variation within industry, almost as much variation within industry as across industries. So carbon emissions are reported on a yearly basis, and stock returns, well, you can calculate stock returns on a daily basis if you want, but what we're doing is we're looking at stock returns on a monthly basis. And so what we are estimating is a pooled regression where we try to explain monthly stock returns, the average monthly stock returns over a year of a company and how it varies with the carbon emissions of that company and other explanatory variables or controls if you want. And we include year-month fixed effects, and the coefficient of on the carbon emission measure is what identifies the average carbon premium in our analysis. And here are some of the headline results when it comes to the premium. So here what I'm showing you is how average monthly returns for companies in the US are affected by the level of carbon emissions. And what we have here is the level of Scope 1 emissions measured in logs, Scope 2 emissions, and Scope 3 emissions. And what you can see in the first 3 columns is that the coefficient is positive and statistically significant. And the coefficient is even more significant and even larger once we control for industry by adding industry fixed effects. What this is telling you is that the variation in emissions, where it matters, maybe the most, is within industry, not across industries. Now, these results are even stronger for changes in emissions over a year, year to year, which are reported here. And however, these emissions, the premium as a function of emission intensity is neither significant statistically nor very large. That's a very important finding because
Patrick, 5 minutes.
Yes, thank you. Because the industry has been paying so much attention to this emission intensity variable. So those are really the headline results. Now turned in my last few minutes on the question of economic mechanisms. And as I said, a carbon premium cannot really be explained by a systematic risk factor. It is explained neither can it be explained by divestment, but limited attention, this is what I want to end up on. Limited attention by investors, coarse thinking, clearly plays an important role. And so we find that a little bit by looking at how the premium varies before and after Paris. This is what this table shows you. You can see that after Paris, the premium has gone up slightly, but it's not a big change. The really significant results I want to show you are reflected in this table. So what we do here is we look at the premium in the 1990s when climate change was not really debated much. And we look at how this premium varies with emissions over this period, imputed back, because of course we don't have data for emissions for this period. So we impute it back. And then to check the validity of the imputation exercise, we do the same thing by imputing emissions back over our sample, taking the 2017 measures of emissions and imputing them back up to the beginning of our sample. And what we find is that the imputed data works just like the reported data for our sample period. But over the 90s, there is no premium. And this is really telling us that the world has changed. Investors are now worried about climate change. They're worried about transition risk. They're worried about how it is reflected in emission, the level of emissions, and they're pricing that risk into stocks. I'm looking at my last slide here with my concluding comment, but I think I've said what I had to say. So Xavier, let me not read through my last slide and end it here. Thank you.
Okay, thank you very much, Patrick, for this interesting presentation. Sophie, the virtual floor is yours for 10 minutes.
Thank you very much. It's a real honor to be here, and I just want to remind everybody I'm not an academic, so I hope you will be more lenient with me than perhaps professors, but I looked at this paper with multiple hats, as Xavier pointed out earlier, and I want to really congratulate Patrick for this excellent paper, because it validates what we may believe and is showing that it's actually generating something that's probably more than what we hoped. But this is a very, very positive. So my background, just in a nutshell, and we thought it'd be useful, is because I have the investor hat, I have the former activist hat. I created investment models around ESG factors that included gender diversity is not climate, but it's a factor, and also serve on boards. And what we thought might make sense because of the diverse nature of this group and audience, perhaps just to say and set a high level discussion to start with what is really ESG, just to know what we're talking about, because climate change is in ESG, but it is not only ESG. And so ESG goes to really the core of long-term sustainable growth. It goes to resilience, which is what Colin mentioned. And I just wanted to point and share with the view that I see purpose as something critical. Critical as a director of a company, critical as an investor, and I think really it shows, it engages people, it engages the employees, and it gets people in a conversation together as to what the company has, where the company wants to go. And it's really about who we are. And ESG is kind of like the building blocks of purpose. So once you've defined the purpose, then you start really building your house. And if your ESG is really good, then your house is going to stand well. And if your ESG is really poor and your purpose doesn't really make sense, and the architecture doesn't make sense, then your house is going to crumble. And it's the same thing with corporate purpose. So the E in ESG is environmental criteria. It includes the energy that a company takes in, the waste that it discharges, the resources that it needs, and the consequences for living beings as a result. And I'm taking this from a McKinsey report, so I just want to say that because I did not write this. The E encompasses carbon emissions and climate change. Every company uses energy and resources. Every company affects and is affected by the environment. The S addresses relationships a company has and its reputation with people and institutions in the communities where it does business. S includes labor relations, the diversity and inclusion. And again, every company operates within a broader, diverse society and has diverse stakeholders. The G is governance, and it's the internal system of practices, controls, and procedures of a company that adopts to govern itself and to make effective decisions and meet the needs of external shareholders, stakeholders, including shareholders. And every company has a governance system. So there are many studies that have shown that governance generates alpha. That is indisputable. Investors have been focused on that. I myself have, as an activist, have invested on governance issues and shorted stocks with companies that had poor governance. But what we're really seeing now is a big change on the other factors, not the G, but the E and the S. And what we found in the past is that, you know, bad governance created a discount and good governance generated premiums. It protected companies, it made them a little more resilient, and investors have a tendency not to require higher returns from a good governance company, but require high returns from poor governance companies. And that is very consistent with what Patrick just found. And that's what I think is so compelling with this paper. And unknown a few years ago, ESG type investing was really a very narrow field in what I would call socially responsible investing, impact funds, which we all hear about. But these were really the pioneers of ESG, where they adapted philosophies that take in environmental, social, and governance factors, get the data that they could get. They would often collect it themselves, and then develop their investment methodologies, screen companies, invest in them, push them for change. But that was then, and then it was a few billion. Today, it's more than 30 trillion. And so what we've seen is a transformation, not an acceleration, a transformation of incorporating ESG factors in investment methodologies, and a growth of ESG investment products. And there are multiple reasons for that. The first is a societal shift, which actually Patrick mentioned earlier, is purpose, and which Colin meant. It's all about purpose. People want purpose, and investors want purpose. Their clients want purpose. The second is new data. And Patrick mentioned earlier that he had to imagine the data or re-engineer the data pre-2017. Well, there was no data for a lot of these companies because it wasn't collected. And now that we have the data, we're discovering all these new factors. Factors on human capital, we're getting employee turnover rates, all these metrics and measures that will allow us to find if there's a correlation between employee turnover and returns. And studies are showing that there are. And then new technology, which Patrick mentioned for transition and for energy transformation, but it's also in the investment area. And what it's done is that it's lowered the competitive entry barrier so that you have new entrants that are offering to consumers and to individual investors tools and products to start selecting their investment decisions around ESG factors. So the big investor institutions have to catch up. And this is really all about marketing and market share. And these trends, when your clients want something, you adapt. And that's why we're seeing this acceleration. And so what I'd like to, and then finally, I just wanted to point to a 2015 study by Deutsche Bank that aggregated results from over 2,000 academic studies in ESG performance. And what they found is that 63% had a positive correlation with ESG, 8% had a negative correlation, and the remainder had none. And again, to me, that means it doesn't mean there's none. It may mean that there's just not enough data. So now I'd just like to go to the study, which I found very, very interesting. And again, like I said, I think they're very consistent with what we've seen in governance and then other initial studies. What's very consistent is that material factors, and again, it's about this materiality. If it's important, a material factor is something that an investor believes is significant and that can have a financial impact in the performance of a company. If an ESG material factor clearly will have a correlation, will have some way, will be impacted or will be priced in the shares one way or another. And if that material factor is well covered, then the company will get a premium. And if that material factor is not well managed, then that company will get a discount. So he points to large, the screening system where the large number of companies that are high carbon emitters are actually screened out. And what I thought was very interesting in that, and it's very logical, is that when you screen companies out from an investment pool or a potential investment pool, then what happens is that you have fewer investors. And when you have fewer investors, you have to offer a premium to those investors. And that to me is very logical. And as investors are screening, and it's not just going to be on climate, it's going to be on a number of other issues, but climate is the most significant today. As companies screen out the heavy polluters or the heavy carbon emitters, then the companies have fewer investors to raise capital. And when you have fewer investors to raise capital, those investors can set better terms. And that's kind of what we're seeing in the market today. Another point was he mentioned was investor awareness. And I thought that was a very interesting point. And he mentioned in his paper, referred to Climate Action 100+, which is an organization I know well, because I worked with them before just at their time of launch. And just to give you a sense of how far we've come, is that at the time, prior to Climate Action 100+, there was a meeting around, I think in January, at the time of the Paris Accord, the same month of the Paris Accord. And at the time, there were about 20 investors in the room, and there was clearly no common language or framework in terms of understanding what investors expected around climate. There was no real awareness, but I would say understanding of the issues and what they could do about it. And so if you have investors that don't agree, then building any kind of investor consensus or investor expectation or even investor coalition like the Climate Action 100+ would be like herding cats and very, very unsuccessful. And so what we've seen in the last few years is not just investor awareness, but a common understanding, a common framework, and a common objective around climate change. And that is going to accelerate as well. And I would just like to add a few to what's not mentioned in the paper that I think is worth mentioning, which supports Patrick's position. One is the emergence of new climate disclosure frameworks, as I mentioned, but in structural frameworks, not just investor understanding. Those are EU regulatory, but also the GRI, the Task Force on Climate Disclosure, or SASB in the United States. And what these organizations have done, and very effectively, is that they have provided a roadmap for companies and for investors to start measuring some of these material topics, and climate change in particular. The Task Force on Climate Disclosure is a very powerful organization, and I recommend those who don't know about it to look at it and to go on their website, because what it's done is it's offered the principle, the roadmap to transition to a lower carbon economy, and it's given investors a common language to get companies to start disclosing what they're doing in that transition plan. And I think that is a factor of acceleration, because companies will start disclosing. And another new element going to the investor awareness that supports Patrick's paper is the appearance of new regulations on investors themselves. This doesn't exist in the United States, but it's much broader at the European level. And investors have to disclose their carbon footprint. In France, for example, you have to disclose your carbon footprint in terms of your company as an investor, but also in terms of your portfolio. And if your portfolio has a high carbon footprint, then there are consequences to that high carbon footprint. So what happens is it forces the investor again to screen out those companies and accelerate that screening out, or to justify why those companies are in that portfolio and require a higher premium. So what I think, and I wouldn't be surprised that over time, what Patrick's findings, that premium will grow if companies can't transition to a low carbon economy. Wanted to point out the few things that I think were excluded, and I think that it's worth mentioning, is the notion of scope 3. That's a very technical thing, but the reality is it's the emission that affects all companies. And it's really what it does. It's a free riding concept or freeloading concept. So a lot of major companies will get the premium and will be appreciated by investors as non-polluting, but in fact they're transferring the pollution to downstream in their business. The second is that carbon data is still very estimated and very iffy. And so I think as carbon data gets better, we'll have probably even better results. I do want to point out that, and I recommend that, I thought it was a very good point that he made, was the Exxon in terms of the exclusion. And what we're seeing in a lot of companies is that companies, as mentioned by the Exxon CEO, they're getting rid of their assets, they're high polluting, so that they can get a better premium. But the reality is they're just transferring, again, that liability to somebody else. So investors increasingly are focusing on companies that are transitioning and making the efforts to transition what you would call dirty assets into cleaner assets. And those companies are going to get rewarded. And so we're seeing with that. And then finally, I just wanted to conclude, with one, I think, very important point, is that investors may be saying they're supporting climate change. They may be saying that this is really important, but the reality of the matter is what they say is not always what they do. And so as we're seeing more and more transparency, we're also seeing transparency in terms of voting and in terms of the portfolio holdings of the companies. And so a lot of the investors are getting more pressure because they have a policy on climate change. The pressure is to take action. And then finally, I guess this is the real conclusion. I just wanted to, Patrick really showed that the premium changed after Paris, and over the 1990s, there was no premium, and there's a premium today. I just want to say that we're going to see that with every single ESG material factor, whether it's diversity, whether it's inclusiveness, whether it's labor relations, and of course, climate change. So thank you very much, and I encourage those who haven't read it to read Patrick's compelling paper. Thank you.
Thank you. Thank you for your comments. So we have some questions. Also myself, I have some questions, but maybe Patrick, do you want to react to Sophie's statement, or we wait for the questions?
Very briefly, I want to thank Sophie for her comments and also for the broader context she's given, which is very important. I thought in particular all her comments around Climate Action 100 were very important. And I want to add one additional comment, which maybe I'm anticipating is on some people's mind. And it's the link, the link between purpose on the one hand, taking an ethical stance, and the reality, the financial reality of pricing of risk. So I think it would be a mistake to conclude that from our study that markets will catch up once the measurement is there. They will price in the risk, and we can continue as before, just with a richer set of evaluations of the risks that companies are selling to their investors. I think that would be a mistake. I think the way we should understand the role of purpose is that often it takes time for investors and the broader world to understand the impact, the real impact, environmental, social impact of company operations. And part of purpose is to educate investors about that impact and to anticipate their future concerns about that impact and to accelerate the transition toward minimizing environmental and social impact.
Thank you. So let me pose a question that I think it's on the minds of many people, maybe some investors also. To what extent these ECG factors are just window dressing, that's to say greenwashing? Shouldn't we set some more quantifiable objectives to check the materiality of the actions, both of firms and investors? Also, this reflects in terms of reporting. So what are your views on that?
Yes, thank you. That's an excellent question, and it really ties the two panels together. Greenwashing is a concern, yeah, I mean, it's not a behavior that is just invented. It's not fake news, if you want. Greenwashing is a real issue. Now, the way we are addressing this issue in our study is we're looking at actual emissions for impact and to determine behavior, as opposed to ESG ratings. The greenwashing is very much in the ratings because ratings are based on how companies communicate with the raters on how well they're behaving on the environment. And it's not, the ratings are not necessarily based on actual measurements, at least when it comes to emissions. So the short answer is greenwashing is a concern, but our study does address this issue because it looks at direct measures of emissions as opposed to ESG ratings.
Yeah.
Okay.
Sophie, yes,
you have?
Totally agree with that. I think one of the things there have been studies on the ratings themselves, and those ratings actually have no correlation with one another. And that really suggests that the ratings seem to be weighing certain factors. And a rating is like a grade. So I think the raw data is the most important. I just wanted to add to that, and we're seeing this in trends, and I see this as board member, but also I see this with investors, is that companies are being asked to really disclose numbers, disclose their data. And my guess is in the coming years, we're going to be seeing maybe at the European level, a more transparent data platform for companies to put their data and for investors to collect it and researchers to analyze it. So I agree entirely with Patrick's point.
We have a question from the floor, which in fact it was a question that I also was thinking about. It's a question from Per Stromberg. And he says, my feeling is that European investors have been concerned about climate risk for some time, while US investors only in recent years. Is there an indication of this in your data and in your experience?
Yeah, I wish I could say, give you a clear answer to that. It's difficult to give a clear answer to that. So one basic reason why it's difficult is even if you can track the premia year to year over a sufficiently long period and contrast premia in Europe versus the US, one of the challenges you're going to face is that Europe is not the same as the US in other respects. Europe varies in many other respects, and so you're going to have to basically identify what the source of the risk assessment by European investors specifically tied to emissions. That's a very difficult exercise. Now, what we can say, though, based on our subsequent study, is that as a result of the actions taken in many European countries and also in the EU at large, in terms of pushing ahead the energy transition, helping the relative growth of the green sector relative to brown sectors, as a result of those efforts in Europe, to the extent that you can do comparables, compare the same companies in US and in Europe, you find lower risk premia associated with carbon in Europe than in the US. That's what we find.
Okay. Sophie, is that consistent with
yes,
your view?
Yes, absolutely. Well, so two things. One is that's the tide is turning, and Patrick pointed to the fact that the regulatory framework in the US was turned in 2016, and that's very, very clear. What happened, though, and I don't believe Climate Action 100 Plus would have occurred had it not been for that. What happened is that companies and investors have decided to take things in their own hands, including in the United States. And we just did a study with Columbia, but at the Milstein Center, so not with Patrick's group, but we just did a study surveying 130 investors and directors in North America and Europe. And what we found is that 2/3 had believed that it had a material impact and that it impacted business operations. So this is, to me, something that we would have not seen probably 4 years ago. So clearly the tide's turning.
Good. We have another question, I guess more directly to Patrick. Whether your results imply that companies that take steps to reduce their carbon footprints, but by purchasing carbon offsets, reduce carbon risk, or what's the impact on premiums? Is there any evidence on this side?
Yeah, that's a really great question. So and I think it ties into a point that Sophie made earlier. It's one thing to take active steps to reduce your emissions. It's another thing to sell your highest emitting assets or to buy carbon offsets. And investors are picking up on that for sure. Obviously, you might be concerned about a company, you might be more concerned about a company that achieved reported lower emissions through carbon offsets than for the same company that achieved lower emissions directly. I think one of the big questions overhanging this entire sector currently is, and in fact, I think this is something that investors probably are already thinking about today, is that aren't carbon offsets currently, aren't they underpriced? And what risk are investors facing if there was a sudden increase in pricing of the carbon offset? You know, what would that do to their stock returns, to reported performance of the company?
Absolutely. So this is a very important issue. Relatedly, and also to what you both have talked about, the ECG factors, have you looked at other variables together with these carbon emissions variables, like it's mentioned in a question, waste treatment, water use, these employee turnovers, gender equality, and so on? So in a sense, do you have any evidence, or have you checked or seen any evidence of the conjoined effect?
I think Sophie would be better placed to address this question. I mean, the short answer is we haven't in our study. We don't have that data, but she has looked at other ESG impact variables.
Sophie?
Yes. So there are I mean, so let's step back a little bit. So I'm not an academic. What we did do, for example, in gender diversity, is that we were able to identify. So we used data from VE Moody's provider, so the raw data, and we were able to backtrack this gender data. We could backtrack it for a number of years, and we could actually see that there was a positive impact, or a positive impact in terms of performance, but we didn't do it at the same level. There are a lot of studies that show gender, for sure, governance, for sure, employee turnover and all those, you don't have that yet. For the simple reason is if you can look at any annual report, you don't get that information. So that information is very, very new. But they're also increasing studies that show that some of them cross over. But I think I want to just go back to one point that Patrick made at the onset. It's this whole notion of materiality. So if people in your organization are the most important asset of your organization, employee turnover will be critical. If carbon emissions and transition is the most important for your business model, then you will get that premium. And I think that's why the scope 1, scope 2, scope 3 is so important. And again, it's all about the materiality. If you don't have the materiality, investors are not going to factor it in.
Very good. I have just a final question from my own to close the presentation on the panel, which is kind of, I think, relevant today. Do you see any interaction between acting against climate change and protecting from pandemics?
So there's a direct scientific answer to that. The climate change makes the risk of pandemics greater, because climate change, for example, through deforestation, makes the transmission of viruses from animals to humans higher. So there's the direct link. However, I think another way of looking at it is that the pandemic has, we're sort of acting as if we're living through something that never happened in human history. We conveniently forgot about the Spanish flu and the plague and this and so on. We're in the modern world. It doesn't work again. And I think what it is teaching us is that nature matters, and we have to take nature seriously. And I think that's where the two are linked.
Yeah.
Sophie, do you want to add something, or you agree?
No, I agree. I mean, I think everything you said, and I would add, if there's one thing that the pandemic is showing us, is the need for resilience. And so this whole, going back to Colin's speech on purpose, but the whole long-term attitude and the whole idea, saving money for a rainy day, companies have not been doing that. many companies have not been doing that. Companies that were very, very strong, did really well in the stock market for the last 20 years, could barely survive 6 months because they distributed all their cash. So I think this whole ESG, the climate change, all of that, it's about being mindful, it's about being purposeful, it's about being prudent and sustainable, and it's about integrating all of these factors, human factors, environmental factors. And what the pandemic has done, practically speaking, is that it's shown companies what a corporate crisis on a global systemic scale will look like. And so climate change is a global systemic risk. A pandemic is a temporary global systemic risk.
Let's hope so. Let's hope so. In fact, we have to close, but let me profit from this answer, mentioning that both Patrick and I were involved in a project of a report about the resiliency of the financial system to natural disasters. So which is
there you go.
very much to the point. So I profit to do this publicity here.